Welcome to Breaking Banks.
In 2013, Harlem Shake, Thrift Shop, Blurred Ball battled at the top of the music charts, and we were all glued to our seats waiting for the finale of Breaking Bad. And for better or worse, twerking went mainstream. And Breaking Banks recorded its first show. If you look at how far the financial services industry has evolved since 2013, it's pretty mind-blowing. We saw the explosion of VC-backed fintech deals begin to take shape, moving from $2.8 billion in 2013 to a whopping $28 billion in the last quarter alone. We saw the rise of neobanks. Ron Shevlin advocated to retire the term PFM. Cryptocurrencies went mainstream, sort of, and more and more traditional financial institutions began to adopt more and more digital technologies. Major regulatory changes pushed fintech to the top of the agenda for banks in Europe and elsewhere, and that's been further accelerated. The global pandemic forced the hands of even the stodgiest laggards. What does this all mean? And is it enough? One thing that hasn't changed, nearly 400 episodes later, on this 8th anniversary show, we're joined by some of the greatest minds in the industry to discuss the past, the present, and the future of banking and fintech. So come along for the journey as we explore some of the best moments in history of the show and hear from some of our guests and contributors. As always, thanks for sharing Breaking Banks, and your 5-star reviews help others find the show. Subscribe to get the latest episodes delivered in your favorite podcast app. We're going to start with Joanne Barefoot. Joanne, always a pleasure to have you back on the show. You've been here many times. Are there any key moments that just stand out to you?
Yeah, great to be here, JP, on this great occasion. There are too many to try to summarize. One might just be the first time I came on the show and could see Brett in his studio with his whole setup and just thought, wow, this thing is serious. But what I really would rather do is just tell a story about Brett, because it happened about the time the show started. And that was the first time I ever saw him. He was speaking at a big conference. It was a keynote conference. And it was about 8 years ago. And guess what? I still remember what he said. Think about that. How many speeches have we heard over the years where we can remember anything that the person said? Brett showed a slide of a little toddler, daughter of a friend of his, and she was trying to manipulate the page of a printed book as if it was an iPad. And he was, get ready for this, guys, because the future consumer is not going to put up with your old banking products. And since then, Breaking Banks, through the books, through the speeches, Brett has transformed the industry. He was the first, he was the best. He changed everything. No one ever saw anything like it before or since. So it's just been a thrill to be connected with the show.
Yeah, I remember reading Bank 2.0, where Brett coined the phrase that banking's no longer somewhere you go, it's something you do. And, here in a month or so ago, a banker kind of repeated that back without attribution. It was kind of internalized as, it was a brilliant insight for him. They were talking, it was a bank executive talking about his own bank. And he kind of said that, somewhere you go, it's something you do. I said, yeah, I think I've heard that before somewhere. And that was the idea of not just Brett's speaking and his books, but the whole idea of starting the show. And I first joined as a guest in 2013. I was then co-founder of the Bank Innovator Council. I had left a banking career after 20 years and knew that those that were trying to innovate and get new things done inside the bank were a lonely bunch, and they wanted a club to belong to. And Brett actually helped us kick that off in our first event and had me on the show and talk about it. And so you think back, it's I think of one of Bill Gates's quotes that, we tend to overestimate what happens in 2 years and underestimate what happens in 10. Well, we're in the middle of that right now, 8 years, and you think about so much that has happened since then. And, certainly in your own life as well. And you spend a lot of time thinking about the regulatory side of the business and reg tech. Jamie Dimon's been talking about lately, and talk about what's changed over the years. He was not a believer in cryptocurrency, now investing kind of big into that. Certainly was early in partnering with fintechs and to say that, look, fintech and other companies from Silicon Valley are going to eat our lunch. But he's also talked about regulation level the playing field. What do you see? What's the kind of truth and the fiction still around that regulatory landscape today and maybe compared to 8 years ago?
Yeah. Well, for one thing, the fintech sector needs to be going to have a lot more regulation. It's going to be coming pretty soon. Some of it is because of the political moment we're in the United States with the new administration. Congress. And some of it is just the maturing of the space and the fact that it's not a little tiny thing on the side anymore in people's lives. So people need to be prepared for a lot of change. And this audience in the US needs to know that there's a lot of skepticism from many of the new leaders in Washington, and people need to be ready to tell the story of what they're really doing to make life better for them. But the other thing I'd say about Jamie Dimon's point is that I don't think we have regulatory change that is aimed at making the landscape level between banks. But the more profound thing that's happening is that the line between banks and fintechs is just blurring, and it's not as relevant a question as it was before. It's still true that if you take consumer deposit insurance on them, you're in a special category. But banks are working with fintechs and vice versa. Fintechs are becoming banks. And they need fintech to be competitive and to survive. And, the whole thing is completely realigning. And the other point that I'll make on this is that I do think playing field will level through RegTech in terms of regulatory burden. We're going to have new regulation, although we will, but it's also just that when we get technology into the regulatory and compliance process, and we're getting there, that is poised to be huge. We are going to find that a bank can more easily compete with a fintech. We're going to find that a regulator can regulate both kinds of activities in the same way, digitally, instead of through the bifurcated system where one on-site exam and the other, gets looked at from time to time from a distance. That whole thing is going to be merged. If we do it right, it's going to be a very efficient, lower cost, and more effective and really stronger regulatory system because regulators and risk managers will have a lot better data.
Well, how has that RegTech space been evolving over the past 8 years, or maybe even less than that? Is RegTech even 8 years old yet?
Yeah, I wouldn't call it 8 years old. I've heard people claim that the term was invented before that, but not really. And RegTech has been following in the footsteps of FinTech the whole way along. I like to say that the digital technology drew a lot of real into finance with their new products and services. And when they got there, they looked around at the regulatory setup and they said, I can't believe it. And so people started creating RegTech.
But you're not a fan of Excel spreadsheets?
Yeah. Things out there, I'll tell you. I mean, we still got the government is, running on COBOL and all of it. But these things are changing fast. I work, as you know, JP, constantly with regulators in the US and around the world. They are embracing innovation rapidly for a whole host of reasons, all accelerated also by the COVID experience of the past year. And one of the things that's happening is the banks will be more and more able to use RegTech because their regulators will be smiling on it instead of frowning at it. And we're going to see the time, it's not that far ahead, where a bank is going to have to be worried about not using a high-tech new compliance tool instead of worrying that if it tries one, the bank examiner will be uncomfortable with it. That's going to flip over because these tools are just better. If I can say a little, so the reg tech firm that I co-founded 4.5 years ago just was recognized as the best for compliance and risk by Finax Tech, bank director. And, that's bank focused. And as banks really become able to use these, and they've got to, at the same time, they've got to work on their own core technology, being able to put good digital solutions to work. This is what's coming.
Well, and even just this week, you talk about the lines blurring, and Chime and apparently other neobanks are in for the same kind of treatment here, that they can't use the word bank or banking, right? If a bank, and I sent out a somewhat tongue-in-cheek tweet around the American Banker article saying that the laggard banks that are hoping this fintech fad goes away soon will be saying, "Aha, checkmate," and nothing could be further than from the truth. That just because they can't call themselves a bank, I mean that is such a minor point on that. And but you also talked about kind of the regulatory environment, and we've been in a deregulatory mode for the most part, right? For 30 plus years now. Post the global financial crisis, we had Dodd-Frank and a little bit of re-regulation, but then that kind of faded away, at least under the last administration, and we kind of had lighter reins. Is it just cyclical like that? It'll depend on administration, or is there a macro trend? Do we get back to re-regulation, or is it more deregulation, do you think?
It's somewhat cyclical. I've been around the regulatory world long enough to know that, but there is I think that, and some of it is because the technology has changed so much. This is not, as you evolution of old analog era technology. The digital technology is a different generation, it's different foundations. And so it's really transforming a lot of things. And we're also in a moment in COVID has changed so many things. And certainly one of them has been that the murder of George Floyd galvanized thinking everywhere throughout the United States and around the world on really trying to solve problems hard to solve in every sector, including in finance. And I think we're going to see a tremendous regulatory and policy focus on how do we really make financial services fair to everyone, not discriminate. How do we close the wealth gap? How do we catch discrimination in ways where, if the bank had, it would catch patterns that could be construed as discriminatory as soon as they pop it and help the customer and keep themselves out of trouble at the same time. These problems accumulate because they're buried in what tools for finding them are terrible today. So that is all changing. And so we're going to go into a period of very, very difficult and important regulation where I'm hopeful that policymakers and regulators will be figuring out the rules of the road for how technology should be used in finance to enable great innovation, also make sure that it's fair. So how are we going to use AI? How are we going to make sure it's not biased? Protect people's privacy. If we do those things right, it will help the fintech world. Wrong, it'll be really bad.
Yeah, I mean, I've said this before, but this idea of leveling the playing field, I mean, on the surface, that makes sense to everybody, right? But for some bankers, at least, I think that means, can we drag the modern fintech companies back down to our landscape, which is, pen and paper and brick and mortar based, and dealing with regulations that most of the most relevant ones written in the 1960s, 70s, and 80s. And what you're really talking about is actually not only leveling, but kind of raising the bar for everybody and using better tools. And I think some tweaks on the way the regulations are written. I think the outcomes are the same thing we wanted 40, 50, 60 years ago. But how we get there, and the speed and efficiency with which we can get there, and determine compliance, I think is way better today than it ever has been in the past, and I hope that's what the future looks like. Well, if you're a leader of a financial institution today, listening to this, I mean, Joanne, what advice do you have? What do you think the main focus should be going forward?
So I know it sounds, it's hard for people to do. The main thing is you have to digitize everything. And when we say that, we don't mean top of your old system or your old process or your old website or any of it. We really mean down to the foundation level and building it differently for today's generation. And let's remember, tech trends and regulatory trends are converging with demographic trends. Millennials are the largest generation in the history of the world. I said the other day that by 2030, they will be 1/3 of the workforce. The older ones are entering their 40s. I'm a baby boomer. They're taking over the world from the leaders from the baby boomer generation and the Gen Xers. Customers won't put up with bad old technology. Employees won't put up with bad old technology, nor with companies that aren't doing their best for people. We're seeing this tremendous surge in green finance. That's one piece of advice I think about how your organization is dealing with climate change. AIR just helped launch something, Climate Accord, a month or so ago, working on how the crypto sector is working to decarbonize, given the intensive use of energy. I just think that the practical advice is get out of your silo, get out of your comfort zone. Different kinds of breaking banks, every show, learn, and then just be ready to do things differently. People don't like to hear this. It's true. Young tech is better tech. Old tech has a harder time than digitally native tech can do. And that's a hard thing for an existing bank that has, what call the innovator's dilemma. It's hard to lean away from what you've been doing that's working. But if you don't do it, I think you won't make it. You're going to have to make this leap.
Yeah, it's more than what we like to call just putting digital lipstick on the analog pig. And you mentioned AIR. Talk a little bit more about what you're doing with AIR, and tell our listeners where they can keep up with what you've been working on, and where they can find your latest materials.
Thank you for asking. So something exciting has happened for AIR. Best Company World Changing Ideas Awards just this week, and
congratulations.
We're an honorable mention in the category of policy and politics. And honestly, JP, if you think about our subject matter, we just thought it was a miracle. We had a lot of good company in the honorable mention category. CNN, World Economic Forum, and so on. So we're really excited.
And we should well, Joanne, I want to point out, AIR is AIR. It's the Alliance for Innovative Regulation. So continue.
People used to think was an oxymoron, but no more. So we're doing a lot. Our website is regulationinnovation.org, and there you can see information on the Crypto Climate Accord. You can see what won the Fast Company Award, which is that we've started an accelerator that is taking breakthrough tools that come out of running tech sprints and incubating them in an open source environment and making them into tools that can be used by regulators and risk managers for free, everyone. And it's such a game-changing way to try. We have to break down we have to make the regulatory world. And one of the steps toward that is really using a lot in open source. So we've been doing that. We've got initiatives in equity, and I mentioned green finance and women's empowerment. We're running a two-part with the UK Financial Conduct Authority on how women have been disproportionately impacted by COVID and how technology can help with that. We're doing a lot of work on trying to help community banks stay competitive, and very excited about it. And we've got some even bigger things actually about to be announced, really, really, really big things that I keep your eye on AIR.
Well, you can find out more about AIR at regulationinnovation.org. Joanne Barefoot, always a pleasure to have you throughout the years, and thanks for joining us on our 8th anniversary show.
It's a pleasure.
So I thought I'd reach out to Rich Turrin, who is the author of Cashless China, Innovation Lab Excellence. If you haven't read Cashless, you must read it. If you don't know the Chinese fintech and payments market, it's going to blow your mind. But Rich, I thought on this occasion of the 8th anniversary of Breaking Banks, can you give us your perspective of how fintech has changed the landscape, particularly in China over that period, over the last 8 years or so?
Yeah, hi, Brett. Thank you all. And, look, it's a great question and a really funny one for me because I moved to China 10 years ago, actually 10 and change now. But when you look back at China 8 years ago, that was before the boom of WeChat and Alipay. So, what I like to talk about is essentially me renting apartments here. So when I rented an apartment, my first couple of apartments in China, of course, I have to pay a security deposit. And that meant going to the bank, and I literally bring a backpack because I would go to the bank and I would get big bricks of 100 RMB notes, all precisely counted and wrapped up in paper. And I would have to give these bricks over to my landlords, for a rent deposit. And it was
Crazy.
A different world. This is pre WeChat and Alipay making payment easy in China. So yeah, I lived through this transition from bricks of money required for large, big ticket items, and the last apartment, bang. Okay, who needs a brick? Who needs bricks anymore? We just use WeChat for everything, or Alipay for everything. So yeah, a really big and noteworthy transaction or transition in the China marketplace. It's dramatic.
Now, of course, more recently, there's been a lot of attention on the big tech fins, and fintechs in general, with some tighter regulation coming into play. Do you expect that'll have any impact on the growth of these organizations, or is it just a maturation process?
It's all of the above. It signals a new growth period for them. And there's a lot to really take in on that topic. So let me break it down. Number one, for those who are watching from afar, and some of you may have bought shares in Alibaba and are terrified of what's happening with the regulators in China, don't be. This does not signal a renunciation, or they're not. Put more basically, the regulators aren't breaking things. Essentially, there was a 10-year period of benign neglect in China. The internet companies got big. They became systemically important, too big to fail, both in the finance and in things like ride sharing. Look, Didi Chuxing, and I like to take the example out of fintech. Didi Chuxing now has something like 95% of the ride sharing market in China. They're a monopoly. They are large. So basically, China has gone from a system of benign neglect of tech companies, including fintechs, and now they are ensuring several things. Their first intent is to ensure that innovation continues. Now, let me break this down. China is no dope. They've been watching very carefully what happened with GAFA companies in the United States and watched them buy all of the smaller companies. And as a result, innovation in the tech market in the US has actually slowed. They don't want that. So they want to make sure that the innovation ground is fertile, that they have more green fields. Now, that's true. Think about how many new GAFA companies have come to be in the last 10 years, which is 0 for the US market, and think of China. Well, at TikTok or Douyin, the Chinese name for the same company, that's a new GAFA equivalent company in China that was born within the last 6 years. So they want to continue with that innovation. And to do that, they have to ensure that the big companies are not unduly advantaged to buying out all of the smaller companies. So that's the number one thing on their agenda. The number two thing is, of course, are they playing fair? So what we saw with Alibaba with their fine was basically Alibaba had a policy, probably goes back to when they were a nothing small company, said, look, we're fighting for market share 8 or 9 years ago with other companies, and we want you to use our platform to the exclusion of others. When they were a startup, when they were new, nobody cared. It was probably okay to do that. Because I want to make sure we don't cast Alibaba at a negative light. But the reality is that they're a big company. So a big company doing that is bad news. It's bad for the marketplace. So again, regulators came in and said, you large companies all have to play fair. And that's a good thing for tech in China. The third thing they did is, of course, to say, who is systemically important? And if you are systemically important, and this would really play to the fintechs, you have to abide by certain rules, and some of these rules are the banking rules. Now, I understand that that's painful for all of us, but what it does is it puts the fintech industry, which is truly too big to fail and systemically important, on a stronger foundation. Let me explain why. Basically, fintech in China existed in a gray area. And what the Chinese government is doing is to take away the gray area, the gray space where they existed, and say, look, you are going to be regulated. You are going to have to follow some of the rules that the banks have. And I will not say that it's not short-term painful for the fintechs. It is. I'm not going to argue that. And I consent that it will impact their revenue. But long-term, they are going to be on a sound and secure foundation for growth. So it's short-term volatility versus long-term stability and long-term growth. Anyone counting out China fintech because of these rules and regulations is selling short the entire industry.
Absolutely.
What you're really going to see is the likes of Ant getting its banking licenses and being just as creative within the licensed space with all the data they have. And they're going to disrupt this space again, but they're going to do it legally. They're going to do it within all of the bounds. And as I like to say, they are going to be just as disruptive. And now we'll have an even greater look. Ant couldn't do home loans. Ant couldn't do car loans. There's a lot of stuff they didn't do. Oh, you wait. Banks, if you
Yeah.
think that you were being challenged before, you just wait to see after the dust settles and after they come after you for other lines of business that before they were, well, we're not going to step into that zone because that's over the gray area. It is a new, stronger tech ecosystem after regulation than before. So that's the good
Absolutely.
news. Remember, the regulators aren't breaking things, they're building a stronger foundation. That's where it's going to be.
Awesome. Well, Richard, thanks for joining us on our 8th anniversary show. Your new book, Cashless, China's Digital Currency Revolution, is a #1 bestseller on Amazon right now. Where can people find out more about it? I guess they can go to Amazon, but where else?
Sure. It's on Amazon, soon to pop up on Apple Books. Those are the two majors. Apple Books is about another week away. By the time somebody hears this, I'm sure
I
it'll
guess
be there.
people can follow you on LinkedIn and see your musings and Twitter on the space as well.
Absolutely. LinkedIn and Twitter. I love LinkedIn, and I'm on Twitter every day.
Awesome. Well, thanks, Richard, and all the best, and see you hopefully back in Shanghai soon.
I look forward to it. Thanks so much for having me, Brett.
Hey guys, shout out for 8 years of Breaking Banks. My name is Matteo Rizzi. I'm the executive producer of Breaking Banks Europe together with the FTS Group. We put together an amazing team after a breakfast with Brett King in Milan a couple of years ago. And now on this side of the ocean, we are at show number 80 something, and we look up our brothers on the other side that are, with so many more shows. So look forward for more life together in this podcast adventure, and I wish you the best of luck. Parabéns, joyeux anniversaire, bon compleanno, feliz cumpleaños. Stay tuned.
Dave Birch, you've been a regular on Breaking Banks since the very early days. In fact, I was sort of reminiscing about this before we got on the phone, and I think it was Chris Skinner that introduced us, and my first meeting with you was actually recording on your podcast regarding Bank 2%.
Yeah, no, it was. And the reason for that was because I can't remember how the conversation came about, but I'm not a big person for business books. It's not really my thing. And to be completely honest, I don't like most of them. Because, you see this is a business book about what would Steve Jobs do or something, taking these utterly unique circumstances and imagining that you can run your pet shop on the same principles. So I'm not a big bit, but I happened across your book, and I picked it up and started flicking through it, and I ended up reading the whole thing. And I just, I thought the way that you pulled stuff together and the way that you mixed actual thought leadership with real examples, I just really liked it. And I'd mentioned it. I can't remember why it came up, but I'd mentioned it to Chris, and that was how come he introduced us. And then I thought, because I at that time I was making podcasts every week, and I thought, well, I have to grab you. And you were just you didn't know me from Adam, but you were kind enough to come and make the podcast. And you're right, that's kind of how it all got started. It was your book, and originally my podcast.
Yes. And so I think it needs to be said, at the 8th anniversary of Breaking Banks, that you actually predated us, because that was in 2010, and we were in we started in May 2013, of course, with Breaking Banks. But maybe let me ask you this sort of in a different way. Your observations, because you've been a commentator and a watcher of the space over that period, so over the last 8 to 10 years, how would you characterize the impact that fintech has had on, the global banking and finance market?
Well, I think that the podcast, actually, one of the reasons why I started listening to it originally was just because because it was you and people that I knew whose opinions I actually trusted. I mean, I kind of listened to it originally for that, but of course, you know, you've done a pretty good job of bringing in a sort of variety of guests to have different perspectives coming into that. And I guess, if anything, they follow what you would probably see as the overall trajectory of fintech, which is basically everything becomes, you know, everyone ends up as a financial services company. And I think the show kind of illustrates just how fintech has penetrated all of these different areas. But I think now, of course, the landscape's a little bit different because, and it's a reflection of the maturity, but of course now I see, you know, there's this going on in fintech, but there's this going on in regtech, there's this going on in insurtech,
Right.
and there's just so much going on in the space, you can't keep up with it anymore.
Yeah.
So I listen to you guys when I'm in the car or out for a walk or something like that, desperately trying to keep up with what's going on, but now I can't. So now I listen to you and I listen to other regtech podcasts, and I listen to, you know, it used to be the only one I listened to, but you've stimulated kind of an industry, right? There's a whole bunch that people listen to now. Can you just hold on for 1 second?
Sure.
You can edit this bit out, right?
Yeah, sure.
Sorry, I'll just tell them 10 minutes. I'd completely forgotten that I'd agreed to 2 calls at 4:30. Right, sorry about that. That's the States, you know. So, sorry,
so there is a lot
let me. So I lost my thread. Let me just say that again. You can edit that back.
Okay.
So the thing is, when I originally started listening to it, Brett, it was partly because it was people that I knew and whose opinions I trusted, because you tended to invite people who I read their stuff, and you know, they were people I thought made a lot of sense at the time. But of course, over the years, you've done a pretty good job of expanding it out to follow, I think, what is the trajectory of fintech, which is this thing about everything ending up as a financial services company, this whole thing about embedded finance and finance permeating everywhere. And I enjoy that very much. But I think the big difference now is, then I kind of only listened to you. But now we're not in a world just of fintech anymore. I mean, now I'm trying to keep up with fintech, regtech, insurtech, and all these other things. So, I mean, it's still a short list, but now I listen to you, I listen to Joanne on the regtech side, and but it's a much bigger topic than it was when you started.
I mean, even just like take challenger banks as an example, or neobanks, which was a phrase I believe was coined by yourself, right?
Well, look,
I tell the industry.
Well,
but
Ron,
you know,
really,
yeah.
But
we used to be able to track every new challenger bank that had launched and talk about how they were differentiated. There's no way you can do that now. It seems like 5 new challengers launching every week, right?
Well, actually, I think on that bit, I think some of my old analysis holds up pretty well, because I can remember saying more than once that I wasn't sure if challengers was the right name for them, because and you saw that thing like earlier in the year. Jamie Dimon said, you know, I'm laying awake at night, and you have to be scared of all it. And he wasn't listing challenger banks.
Right.
You know, he was listing Amazon and Facebook and Google. They're the challengers, not those sort of niche banks. I think that analysis holds up pretty well, I think. But the general point you're making, which is that it went from being something about the finance sector, something about developing bank strategies. Over that period, it's become everything strategies, like everything hinges on this. And we're just about to go into this. We're going over the cusp now, moving into that world of central bank digital currency. That's everything. I mean, that's not even just business anymore. That's everything. So I got to say,
it's about money.
Yeah, you know, I got to say, it's a pretty interesting journey, don't you think?
It's a delightful journey, and it's been great to have you on the team with us over that time. And
I always enjoy it, Brett. Anytime.
The fun. I think that I will just wrap up with this. I think the funniest moment we've had on Breaking Banks was actually a courtesy of you. The most I've laughed, which was when we did that show on, we were doing a show together. I can't remember what the show was now, but we used to do the Fintech news at the start of the show. You remember? And one of those was about the Yahoo breach. Do you remember that
Oh,
show?
yeah, sorry, I do.
And you came out with this line, and it was myself and I don't know if it was Ron or someone else was co-hosting with me. Might have been Chris, and you said something along the lines, you were really shocked about the breach, and you were shocked because you had no idea that Yahoo still had 500 million users, which
I was
a very funny moment.
I was taken aback a bit by that. It's true, and look how much worse it's got since then. You were out of gas last week, right? Because your oil pipeline got shut down by these guys.
Yeah. Nah, I think I'm going to get a Tesla now. Yeah. Well, Dave Birch, thanks for being a part of our history of the last 8 years.
Oh, it's been an absolute pleasure, Brett.
A real value, and thank you for your thought leadership in the space as well.
You're more than welcome. And I'm hopefully I can actually say it this time. We'll have a coffee soon.
Absolutely. Take care.
Cheers.
Joining me today for this special 8th anniversary special is host of Women in Fintech, the amazing Chloe James, and the legendary Jim Marous, host of Banking Transformed. Now, Chloe, congratulations are in order. Your family has welcomed a new member this year. Tell us a little bit more.
We have. Hi, it's great to be here, Jason, and I can't believe it's the 8th anniversary. So exciting. Breaking Banks has been a huge part of my life. But yes, more recently, I have an 8-week-old son called Judson. So he is officially a coronial, I've heard. He was born in the pandemic. We're still living it here in Toronto, but yeah, he's beautiful and joins my family with my husband, Josh, and our 2-year-old, not yet 2-year-old Louise. So we've got 2 under 2. So not getting much sleep.
Oh, not much at all. Well, congratulations. And when I was thinking about who I wanted to sit down with for this episode, I immediately thought of the two of you. One, because this is how I got to know you, Chloe, over the last several years. And Jim, this is the closest we've worked together. Now, I'm curious about what your earliest memory of Breaking Banks is. Jim, why don't we start with you?
The earliest memory, I was on a few shows, and I guess Brett and I were getting along pretty well. And he said, I need you to do me a favor. I need you to take this next show for me. Can you host it? I'm thinking, yeah, okay. I wasn't sure what to do. And as it so happens, I had it all scripted out. I mean, down to the detail, who flips out at what point, when do the commercials run. I mean, just like you guys do. I mean, you detail oriented. You don't want it to fall apart. Well, I got the first guest on, and about 1.5 minutes into the show, the audio went out. He basically lost connection. So now everything I had planned was completely out of control. I think thoughtfully, I think I seamlessly transitioned to the second guest who was on the show. I went to him, and then we went to a commercial, and I'm trying to process, okay, where was I with the first guest? Do I bring back the first? Do I do the second? At the end, it wasn't impossible, but what was interesting, it really gave me the understanding that putting on a podcast is not the easiest thing in the world. You have to always be prepared for the unexpected, even to the point of, oh, by the way, the guest can't connect at all to make the show. And this was when we were doing things live. So
I hated those live shows.
No pre-recorded, man. We were going. We couldn't say, oh, let's stop for a second. Let's pick it up from there. But it was really intriguing. And what I remember from that show and all the shows is you always learn something new. Unlike when you research something that's in a paper or a research report or something, go to an event. These podcasts are always major learning experiences, because you get the dynamic of the personality and the passion during the conversation, which is really kind of cool.
I do love that. Chloe, how about your first memory of Breaking Banks?
I was thinking about this, and I think Brett's going to love this story, but I remember being in Vegas at Money 2020 years and years ago. It's got to be at least 5. And Brett King walked past me, and I wanted to say hello and I was too nervous and I didn't, which I think is hilarious. And he'll probably love that I add that in. And then I think I connected with him afterwards and he was like, Chloe, you should have just had a chat to me. We'd love to have you on and, come and co-host. And that was when, it was that sort of like celebrity walking through Vegas. I honestly clearly remember it. I think he was wearing some, brightly colored sports coat, but just echoing Jim there. I mean, we've had some great guests. I've always loved being a part of it. Contrary to opinion, I love it that it's live. I love those live conversations because I think that's when you really get, really good sort of juicy energy. It's exciting. And I know how Jim feels, when something like that goes wrong. I've had a guest before who's sort of frozen and just given me one word responses, and then you really have to pedal hard
Yes,
to sort of
that's
get
true.
those stories out. Yeah.
Well, it's funny because you also think about the talk show host because, talk show hosts do a great job, but once in a while they get a guest they haven't been familiar with, or the person's just not in the mood, and you get those 1-word answers or 5-word answers. You go, I don't have enough script for this,
because
because
it's going to be very short.
Yes, exactly. I don't have the.
Luckily,
questions
you
to
and
fill
I,
in.
Jim, we can both sort of talk underwater with a mouthful of marbles, so we can keep it going. Actually, all three of us can. To be fair.
Yeah.
So, Chloe, stick with you. You both actually now have your own podcast, Jim, The Banking Transformed, and Chloe, Women in Fintech. Since you've gone and created these other platforms, how have you seen the impact you've been able to have on the industry? And Chloe, let's start with the Women in Fintech, because you've had some absolutely fabulous guests on.
Yeah, I love that. And I've always been really passionate about the women piece. Obviously, I'm a woman. And I've had some fantastic guests from sort of, the more traditional bankers, real big fintech kind of superstars, Lita Glyptis, people, that we all know around the circuit. Some great sort of government people sort of talking about, being a woman in this field. I was thinking about this, and just two things that I think really have kind of come out to me that have always sort of been said is, taking risks as a woman. It's, hugely important to do. These are some things that have come out of the show, and also about building your network. So women aren't traditionally as great at really building those professional networks. And a lot of the women that I've spoken to really echo those two sentiments, those take risks, build your networks. It's why I love what I do. It gives women a voice, their stories, their ideas, their sort of passion. And I'll continue it on. I absolutely love it.
Jim, what about you with Banking Transformed?
Well, it's interesting because I was lucky that before we actually turned the platform on, I had a few guests that I had already recorded at the Financial Brand Forum. So I had Gary Vaynerchuk, I had the ex-CMO of Kodak, I had a woman who is in charge of personalization and transformation at Google, and I had some really good guests to start off, which made it so that from then on, it increase the level of who I wanted to be on the show and my ability to get them on the show. I am still flabbergasted. And this was set up in place by Brett, where you can't shoot too high. It's amazing you can get on the show if you have a platform that people have talked to in the past or know. And you get to the point where you realize at the end of the day, people listen based on, is it a household name, either the brand or the person within your audience of who you're talking to, or is it a topic that's going to draw attention? Now, the downside of this is I've been very lucky. We just received an international award for both the show and for one of our specific episodes. And what that's done, and the number of people that are now listening, it has generated an extraordinary number of requests to be on the show. From many times solution providers. They want to be part of the platform, and a lot of times it's just not the right match. And you go, geez, I'd love to have you in the show, but I don't think you're going to be happy with the results, because people make a determination before they even click on the podcast on whether or not they want to listen. It's not something they just absorb, through osmosis.
I mean, it's funny you mentioned that. Matt Harris at Bain Capital Ventures and I talking about unicorns versus workhorses, and talk about, back to that live problem. He was late to LaGuardia, so we were recording him on a New York street corner while trying to hail an Uber but people still listen to that, both because of, who Matt is, but like this, what do you want, the flashy fintech, or going to replumb banking? But it's still, we have hundreds of listens per week, and it's over 2 years old and still relevant. I might add.
That's interesting because Steve Wozniak was the same way. It was a very short conversation. It was at an event. I had a very limited window that they were going to allow me to speak. Mind you, I took that window and kept on going, oh, one more thing, as people were making me all kinds of signals. But, for me, I got jazzed about that. You get somebody like that and you just go like, this is a legend, talking to Guy Kawasaki and other people. It's just insane what can happen, but it's so much fun.
Yeah. Well, if we look back 8 years, and especially over the year that was 2020, so much has changed, and yet so much has stayed the same. Putting on your prognostication, Chloe, what do you think the biggest breakthroughs are that are yet to come? Or if you look back, where have you seen and say, hey, why haven't we seen bigger breakthroughs yet today?
Yeah, I think obviously with everything that's going on in the world at the moment, e-commerce, used to be huge, and it's just getting bigger and bigger and bigger and bigger. Amazon has tripled their profit since the pandemic began, which I heard on the news the other day, and I thought, I hope that Bezos is giving some money to the COVID funds around the world, because that's just huge. And I order about 1 million things from Amazon every day because I have children, and you just need to order, things that help make them sleep, for example. But that's a huge piece for me that's still growing and continues to. The buy now, pay later piece I was thinking about. Nick Molnar, Australian, obviously same as me. I know Nick from back in Sydney days, and that company is now worth $2 billion. A huge kind of disruptor in the market, and I think that's going to really just keep pushing forward. And then the usage of cash just completely going down, even more so now because no one wants to touch anything without sanitizing their hands. So they were some things that I thought were really important. I think something else that's really big that's kind of coming through is sustainability, and people really caring about their finances and people, and how they can treat their customers. And that's just kind of continuing on growing, and that's treating the customers but also the organizations that people work for, and especially getting some young guns through. People really want to work for an organization who cares. They were some thoughts I had.
Fantastic. Jim, what about you?
It's interesting. I'm going to tie it back to Banking Transformed, the podcast, in that one thing that's coming out more and more, and it's really based on what Chloe said as well, is the importance of leadership that can envision what's needed in the future and actually do something about it. Be it sustainability, be it transformation, be it personalization, be it digital, any of these elements. I think the definition between winners and losers, more than anything going forward, is going to be defined by who the leaders are. And, Banking Transformed continues to have leaders in organizations on the show, and Brett's connection with that. And Brett's a leader. I mean, he's finishing a book right now about the future that I'm sorry, but banking may never see, because I'm not too sure if they can get to that space where Brett's talking about right now. But the reality is the organizations, be them financial or non-financial, are real, and countries are being driven by the people that lead them. And they're either being held back or moving forward. And I'm going to be writing an article on Monday for the Financial Brand around 2 + 2 doesn't equal 4 necessarily, when it comes to bringing together M&As on the financial services side. We've seen that with Truist. We've seen it with a lot of banks. I mean, April is the biggest month ever for M&A work in the U.S. But the problem is, getting bigger doesn't make it better. And it's really going to get to the point that if you have the same leadership, but you have a bigger organization, does it really change the outcome? And I'm not too sure if it does. I mean, I go back, and I think we talked about this point before, Jason, to something that was called the Resolution Trust Corporation, which is where the government said, we're going to put together a bunch of bad savings loans, and we think we can make it into a good bank. It didn't happen because it's still the same leadership. And I'm not going to give the death knell for any of these organizations that have done mergers, but I'm saying, unless you change who you are and truly embrace where you're going to, I liken it to the ropes course. Unless you let go of the first rope and get to the second rope, it doesn't get easier with time. And when I see logos on financial institutions well after the merger that are the old logos, It's like, for me, it's like United and Continental when they got together, and I can still pick out what routes still have Continental people staffing it, crew, than United, and they're vastly different in the way those flights work.
I can tell you from my fitness regime, you can't keep doing the same thing over and over and expect dramatically different results, right?
Or not doing them.
Exactly.
I mean, that's the problem. Behavioral change sucks. I mean, it really does. And if I've been in banking for 30, 20 years, and I'm surrounded by other people that came up through the ranks with me, changing the way I'm going to envision the way I want to go. Number one, I probably don't have a clue on what that really is. We just did a research on the leadership gap with regard to digital. I mean, most of these people didn't understand what digital was. They didn't need to. Now, how do you transform that? Do you either take that change on and educate yourself, or do you basically bring people on?
Well, in understanding that becoming digital isn't just slapping, my favorite digital lipstick on the analog pig. And let's face it, the business model of banking is relatively unchanged since the time of Medici, right? But we're now seeing with embedded finance and where that's going, a lot of this is beginning to change. I want to close actually building on this idea of leadership that you brought up, Jim. Did you read Ron's article in Forbes, Should Fintech Startups Hire Bankers? Yes. And I'd love to hear, as we close this out, start with you. Should fintechs hire bankers?
Well, yes, is my
yes.
He was starting. He was starting with me, Jim. I'm just going to jump in. I did read it. I thought it was a really interesting article. He talks about how the question is, a little arbitrary, perhaps, and it's very interesting to think about who should or could work for either. I interviewed Roy Gorey, the CEO of Manulife, for the Singapore Fintech Festival in December, among another couple of other great leaders. And I really believe in Jim's point there on leaders. And I think you really work for a leader maybe first before an organization. But anyway, Roy's got a couple of really interesting people in his very traditional business, ex-Facebook, ex-FMCG types of people, ex-Apple. And he always says, you bring those people into your business and they can bring sort of a really different and diverse view. I think we're going to see a lot more movement between the two. Fintech's not so new anymore. So I think the points that Ron was making in the article about really needing to perhaps bring some of that, people with the 30 years experience that you're talking about into the newer organizations, and, they need that structure perhaps. I think they would be beneficial within fintechs, and I think we'll see a lot more movement between.
How about you, Jim?
It's interesting. I responded to Ron's article and I said, the NFL draft was just in Cleveland, and I correlated in that just because they're a banker doesn't necessarily mean they should be hired. You got to take the best player available. And the reality is we're already seeing this. Look at the number of transfers and swiping from other organizations we've seen between, Walmart taking people from Goldman Sachs, Citi and Chase taking people from other organizations. We're seeing a lot of transfer because there's a real lack of supply of good digital leaders that are in the banking space that would fit in the fintech space, or that are in the fintech space that would fit the banker space. So you got to be very careful in your draft to make sure you're getting the right banker or the right fintech leader. And at the end of the day, it's got to be somebody that truly has a vision. But more importantly, I'll go to Colin Walsh from Varo and say, you got to have passion. When we interviewed him, it became very clear that his whole mentality, his whole way of doing business, his way of talking about what he's doing is so much different than most of the bankers we have on the show. Now, that doesn't mean good or bad. I'm just saying, I want to get on his boat, because he's got the passion, the leadership skills, and the banking experience to make this happen, which is probably why they're the first fintech to be chartered as a bank.
Maybe it should become like a football draft. Jim, I love that you raised the draft pick. Jason, you don't know this, but my husband and Jim both go for the same football team. And so those two just have this huge text message exchange back and forth. Imagine if there really was the transfers and it became like a sporting event of, we'll have that person from this fintech and we'll have that digital leader from this bank. Something to think about.
Cool. Well, fantastic. Thank you both for joining. Your thoughts. Look forward to another 8 years of getting to work with celebrity guests like yourselves, and look forward to seeing really what happens in the industry as banking transforms, as we see more women in leadership positions, and actually a lot more leaders that aren't part of the old guard of how banking and fintech worked. And the space is really beginning to mature. Thank you both.
Thank you.
Hey, Greg Palmer here from Finovate to say congrats to the Breaking Banks team on making it to 8 years. What an achievement. You guys have done so much for the industry as well as for Finovate and for myself personally. Really appreciate your voice in the space and the role you have played in just pushing everybody forward. From my standpoint, one of my first memories of you guys is obviously being on the show the first time. That's a really nerve-wracking moment in my own life. I'm sitting there in my house with the headphones on, listening to you guys chat so casually while I'm sitting there thinking, and this is going out live to so many people. Obviously waiting for my chance to come in and try not to embarrass myself. I feel like I did okay with that first one. And then of course we go from there to a couple shows later, me giving Brett the bell, the official Finovate bell on stage at Finovate, which was obviously a lot of fun as well. Really appreciate everything you guys have done for the industry and for myself. Thank you for your support. Thank you for pushing us all forward, and congrats again on 8 years. What an achievement.
Well, joining us now is a longtime senior contributor to the show, Ron Shevlin. Ron, you were actually one of the first guests ever on the show. I went back and listened in May of 2013. You were talking then about the opportunity to leverage new technologies to generate new revenue streams. It's been 8 years. How's the revenue doing on that? How's the revenue coming from the industry? How are we doing on that?
I think I have to give it a D minus, somewhere between a D minus and an F, JP. To be nice, maybe give it a D. But the idea, I think, even back then, was that there was this opportunity not just to create new revenue streams, but to create new products and services that could generate revenue. And if you look at it strictly from the traditional bank or credit union's perspective, then it's D to F. But with the emerging plethora of fintech companies, maybe there's some hope on the horizon for that. But I think we got to give the industry a D minus to an F on this one.
Yeah, I agree. You also talked then about, you coined the phrase debanked, right? Not the unbanked, but debanked. People who were willingly opting out of the traditional banking system. And you were talking then about how Gen Y was becoming increasingly open to tech-driven companies that provide banking services. So here we are 8 years later, and one of the most recent things you've written about in your Forbes column is how Chime has to no longer call themselves a bank. And your point was, well, if they aren't a bank, then what are they? And, does the label matter?
Well, it does matter in a lot of different contexts. It matters from a legal and regulatory perspective.
For sure.
And I mean, that's why the banks are kind of up in arms that, they don't want the fintechs to be using the term banking because of that regulatory aspect. But on the other hand, look, Chime has 12 million customers. If you go to them and say, Chime's not a bank, what do you think that's going to happen? They're going to go, oh, I better close out my account. It's funny, I got taken to task. Yeah, that's not going to happen. It's funny, I got taken to task on LinkedIn yesterday by a guy who's in the industry and a regulatory expert, and he said, Ron, you mistakenly referred to these accounts as Chime accounts. They're not Chime accounts. They're Stride accounts or Bancorp Bank accounts. And I said, well, technically, you're absolutely right, and I shouldn't have said that. On the other hand, I could probably find you 12 million customers who think they have a Chime account.
Right.
And so, it does matter, the label, because, technically speaking, from a regulatory perspective, what California did was absolutely right. My argument is change the regulations. Come on, guys, let's get up with what's happening in 2021. I could make the argument, JP, that hey, my mid-sized bank that I have an account with, it's not really their account either. It's Fiserv's or FIS's account. Aren't they the one providing the technology behind it? So, we attribute the account to who has the regulatory responsibility for it, with kind of ignoring where the operational delivery is coming from. And this really seems to me to be just a dumb argument all the way around.
Right. I mean, clearly, from a technical legal standpoint, you're absolutely correct. And I think what you're saying, and certainly my view is, but so what from the consumer standpoint? The consumers really don't care. Now, if and when we go through our next financial crisis and there's, safety of money becomes a big concern, consumers might start thinking about that again, and they might start thinking about FDIC insurance and who holds it and
But
am I
Chime
covered?
accounts, I'm sorry, Chime, whatever, through
Yeah.
those are FDIC
Right.
insured. So,
Right.
I'm still, and I asked somebody in the banking industry, who I won't name, I said, tell me why there is this safety and soundness concern when there is a legit bank behind it.
Right.
And as a matter of fact, since those banks behind it do support a wide range of often fintechs and perhaps even consumers directly through their own, direct bank, couldn't the argument be the exact opposite, that they're actually in stronger position to deliver service than a single bank with, in a particularly, vulnerable geography or location? And, I also got arguments from this around the, like there was that Beam Bank that kind of shut down and didn't, the fraudulent aspect of this. And I sure hope Wells Fargo isn't an advertiser of breaking banks, because I just got two words for that argument: Wells Fargo.
Right.
And so there's fraudulent activity that happens all over the place. Has nothing to do with this argument, but that's the argument that people were trying to throw into it.
Right. And, the beam banks and whatever there are, you don't need very many fingers to count. What are the number of banks that failed because they were innovating on the fintech side, right, or their digital offerings? The vast, vast, vast majority of every bank that's ever failed has failed at the one thing that they actually claim to be experts at, and that is creating leverage, right? Taking in deposits, making loans, and somehow sooner or later they get the ratios wrong, they get the pricing wrong, and the balance sheet gets upside down, and that's what causes banks to fail. Yet so many of the bank leaders are, concerned that all this other stuff is too risky. And I find that ironic, 8 years later, or, depending on where you're counting from, maybe 15 years later into the fintech revolution.
It's funny, JP, because that's the exact argument they use for not getting into providing cryptocurrency.
Yeah.
That was another thing that, just did some research on, and from both the consumer and provider perspective, there are a lot of consumers in the US who hold cryptocurrency today and said that they would prefer getting that from their bank. And, obviously a lot of reasons from a trust perspective for that. And yet you go to the bank side, when I surveyed banks at the end of last year, it is less than sloths have 3 toes, right? It's a 3-toed sloth number of toes that, the percentage of banks that said that they're interested in providing those services, at least back then. I think things are changing significantly.
I think so too.
The argument has always been about risk. And I'm like thinking, okay, but I don't see you stopping your customers from using your debit or credit card when they go to Las Vegas and gamble, or when they pay for cigarettes and stuff, which is harmful to their health. So, to a large extent, look, I get what the risk is from crypto, but it's gambling just like any other form of gambling to a certain extent. So the arguments that they come up with for not getting into the business, I just think are kind of excuses for not shaking things up internally.
Well, the other thing I hear a lot is, yeah, that sounds good, I get it, but we have these other things that we have to do first. And in many cases, that's not wrong, right? They have some aging technology stacks and things that they have to try to address. But I also think that it becomes a little bit of a convenient excuse that it's easier to make some incremental improvements to the things that we've already been doing, because that feels like it's less risky. But 8 years in now, maybe we give the industry a D- to an F on driving new revenue forward. What do you think over the next 8 to 10 years? Will that get better, or will we be having the same conversation 8 or 10 years from now?
I think we're going to be having the same conversation, to tell you the truth, because I think what happens well, it's not even just fewer banks. It has a lot to do with the cycles of the economy and what drives revenue with the banks. And so, part of the reason for the poor score in the past few years is we've had a very strong, lending market up until recently. And look, that's always drives the majority of the income, revenue, whatever, from the bank perspective. And so when your lending volume is strong, the non-interest income stuff, we can put that aside for a while. But, just as any large, let's say consumer product good firm looks at their business and tries to create a portfolio that, is balanced across different types of products and services, I think banks need to really start taking more of that kind of a view and building a base of products that creates a strong enough stream of non-interest income so that they can better weather the ups and downs on the lending side of the coin.
Well, and prior to the last few quarters, we were running on 8-9 years of record earnings. And so it's easy to ignore. There's other things I suppose we should be doing, but hey, it's record earnings, so sue me, right? And clearly we're in a little bit different situation right now.
Although this Q1 2021 was pretty strong. I think that was record earnings for the industry. So
yeah. So when you look back over the past 8 or 10 years, is there any areas you would give an A to, other than your cryptocurrency holdings?
To the industry itself?
Yeah, and I'll say that broadly. Well, and if you want, you can even break it down. If you want to say within the traditional industry of banks and credit unions, and then aside from that, just fintech. I mean, what has gone, maybe better than you expected?
Mobile banking.
Yep.
I do think that there was a much quicker move to adopt mobile banking than there was a move to adopt online banking back in late 90s, early 2000s.
Yeah.
And I think there was a recognition, and obviously though, JP, that was driven a lot by the absolute, boom in smartphone adoption. But I think the industry actually responded fairly quickly to that and moved relatively quickly in deploying mobile banking capabilities. Look, some of them are still subpar for sure, but look, most of them have it in place and have made those investments and didn't use the same excuses. Listen, if you go back even 25 years, not 8 years, you go back to the mid 90s, there were a lot of bankers who said, we don't need a website,
Right.
What's a website? We don't need a website. Then they had to get a website. Then it was online banking. No one's going to really do that kind of stuff. We've been there with telephone banking. That doesn't really work that well. Then they had to do it. Online bill pay. No one wants to do that. Then they had to do it. So there's this history of kind of downplaying it. And I think in the past 10 years, I didn't hear the arguments against mobile banking. It was, we got to do this. And I think they moved much more quicker towards mobile banking than previous technology developments.
Well, you're a data guy, so you probably do know this. But 8 years ago, what do you think the smartphone adoption rate was in the U.S.?
Okay, given that so when did the smartphone actually come out? 2007, 2008?
Yeah, iPhone came out in 2007.
Yeah, so smartphone adoption 8 years ago was probably not much higher than 20-25%, if even that level.
Well, according to your appearance on Breaking Banks, it was 60%, and I think that sounds about right.
60%,
from what I recall. Yeah.
Well, maybe among millennials. But,
maybe. Yeah, and I don't have it in front of me, but I just think, to your point, that this ubiquitous device that everybody has really was a unifier, right? There wasn't a lot of argument within the industry at a certain point of, hey, should we build something for this? Is there a there? And, the launch of the move-ins in the Perk Streets and the Simples, right? Some of the first of the digital-only neobanks, really showed the way of you can do banking on this device here that everybody had. So, I think you're right. That was a thing that changed the game. Anything else besides mobile banking you think either the financial services industry or the fintech industry has done well?
Yeah, I would less tangible, more maybe attitudinal. I think, and I know there's a lot of folks out there, and there might be somebody I might be thinking of in particular, that you'd know them as well, who, often kind of bashes the industry leaders for being slow to do something and,
Right.
laggards. But, actually, I give the industry execs credit for taking the threat seriously.
Yeah.
The threat of disruption, the threat of behavioral change. I don't think there's a bank or credit union executive in the US who downplays the potential for the threat. Yes, they might be slow to move. There's always, reasons, and sometimes there's good reasons for that. But I think compared to, even going back to the early 2000s after the dot-com boom and bust, I think there was a good number of execs in the industry who said, yeah, see, we're still here. But I think now they really do treat the threat much more seriously.
Well, on aggregate, I agree with you. I can unfortunately confirm there are still those that are downplaying it and don't see the need for it. I just heard from the CEO of a bank that was acquired, and she's now looking to leave that bank because the incoming CEO says, that's not us. We're community based, and that's what we're good at, and so they're actually kind of moving away from it. We'll see how long that lasts for them. I mean, the thing I think about is I think the general user experience has gotten a lot better. I do think that the tech drivers have kind of shown the way of what a good digital experience is. That doesn't always translate completely end to end, because I think 8 or 10 or maybe even 15 years ago, we just had this conversation with somebody. You look at somebody like an Umpqua Bank who did really, really great job of driving awesome in-branch experience better than everybody else. They've not been as successful as translating that into digital experience. And I think conversely, there were a lot of banks that were same as in the traditional way, and then actually kind of came up with some pretty good experiences on the digital side. So I hope that continues. What do you see going forward?
A lot of blurring of the lines. I think this move and this trend towards embedded finance, I'm going to just say this. I think to some extent it's kind of overplayed. I do find it really kind of hard to believe that somebody just wants a general bank checking account, spending account with Macy's or I don't know what other brand.
Right.
But the other aspects to it in terms of, certain type of payment types of things, and certainly lending and insurance, I think, will certainly become embedded. So, but the reality is that we're not necessarily pulling the banks out of the equation. It's just a blurring of these lines. And on the other side of the equation, I'm still pushing. So that's embedded finance. I like to make a distinction between embedded finance, which is embedding banking services into the non-banking provider. And I think there's a other side, the flip side of the equation, embedded fintech, of embedding fintech services into the bank's platform. And I think initially we'll see a lot of money related, if not financial related products like subscription management and bill negotiation services and data breach protection services. But ultimately, they've always kind of danced around the edges of providing a broader set of services. And I think once the platforms are, the technology platforms are more established and better in place to do that, I think the banks will start to get more into the retail side, especially starting with money-related services. And I'm using that term to distinguish between, that and a traditional financial product. So, I think we'll see the kind of a move in both directions, but it's going to get real blurry. And that goes back to our, the start of the conversation, which is labels matter. And so, The terminology is getting really, really confusing out there. Bank as a service, platform as a service, cards as a service, embedded finance, embedded fintech. Ultimately, all that stuff kind of shakes out and terminology straightens out. But right now, I think we're in that fuzzy period where everybody's throwing around labels indiscriminately.
Well, and none of those that you just mentioned I've ever heard from somebody outside the industry, right? The average business owner or consumer says none of those words at all. And I agree with the blurry lines comment. And I think that it's the biggest opportunity and the biggest threat for the traditional players, because at the end of the day, who really wants a financial experience? Nobody, right? They really just want whatever the end point of that is, right? They've acquired a new asset, or they've moved money from point A to point B, or whatever it is. And that's why, I'll take kind of the flip side of that argument. For so many of the end users, the labels don't matter. And so it'll be interesting to see whose brand really holds up, right? Is Chime going to be as ubiquitous as Bank of America? Maybe not. But whatever it is that it does for those consumers will be what decides that over the long run.
Yeah, well, can I just argue 2 seconds here to argue this back, JP? Here's the thing. There's still a missing piece, which is advice and guidance on how to best manage your money and your financial situation. And the brands don't have that objective and incentive in mind. They want you to buy their products. They want to give you the loan so that you can buy their products. They want to give you the insurance on that so you can buy their products and services. But there's a missing piece, and you see it already. There's it's my own numbers and I can't remember them, but something like 40 to 45% of buy now, pay later customers have been late with a payment, not because they didn't have the money, but because they lost track of managing it. 40 or so percent of millennials who have more than one checking account overdrew on their account last year. Why? The majority said they lost track of all this stuff. So the ability, what happens in this world of distributed finance, and I don't mean decentralized, that's a whole different issue, but where all these products and services are distributed, the management, coordination, and tracking of this becomes a lot more difficult, and I think that's a role the banks can play. And so, you think about it, Chime has, gained 12 million customers, but they should be just as much a victim of the embedded finance. But because they know their market very well, which is low to middle income consumers, they're better suited to help provide that advice and guidance and carve a niche out. And I think that's what we're kind of seeing. And it's still a threat to the traditional providers, because you have all these new players coming into the market focusing on very specific niches of the market, because they understand the unique needs of those markets. And so, we've said this before, the challenges for a lot of community banks in that affinity is the new community, not geography. And I think that becomes the real threat to a lot of the traditional players.
Well, but part of what I take from what you just said there is it kind of underscores my point in that nobody really wants that financial experience, right? People lose track of things because that's not an activity they want to do. I haven't balanced my checking account in I don't know how many years because, I don't care that it balances out.
Because Mrs. Nichols does it, right?
No, she does not. She's worse than I. I know it needs a number greater than 0 in there, and as long as it's there, I have complete trust that nobody's lost any nickels and pennies. Occasionally something gets processed twice or whatever, and I catch it, but I don't catch it because I spend an hour every month with the back of the statement adding debits and credits together. And so I think that the ones that figure out how to manage that for you without it feeling like somebody's managing it for me, right? It just happens. I think that's going to be somebody who can win going forward.
I agree. It's supposed to be those who figure out how they get paid to do that too. So,
well, there you go. Well, Ron, listen, you've been on the show so many times over the last 8 years. Any favorite moments that you recall?
I have to tell you, one of my favorite moments wasn't being a guest; it was being guest host. I might, I think I was one of the first guest hosts on the show.
You
Maybe not the
absolutely
exact
were.
first, but I remember Spiros Marguerite was on the show, and then a reg tech expert, and I know nothing, still know no, I knew nothing and still know nothing about reg tech, and so. I had to study up and prepare for that show. I can't tell you how nervous I was to guest host Breaking Banks. So that was probably one of my most memorable moments. And I learned the hard way to let you guys do the guest hosting and the hosting. So
Well, that's a
that was memorable.
And that's a nice thing about having Joanne Barefoot as a part of the team now too. She brings the reg tech expertise, and I'm always humbled by the guests and the level of knowledge that folks have on, and it's great to have them and great to have you as always on the show. So thanks for being here.
Absolutely, thanks, man.
So Paul Ark is joining us all the way from Bangkok, Thailand. If you don't know Paul, he is a venture capitalist working with Gobi Partners. Prior to that, he led digital ventures for CM Commercial Bank, which was their fintech investment arm. He also did some work with Apple in the retail space. Spent many years in the US market, but of course has been in Asia, for the last half a dozen or so years. So Paul, tell me about the fintech and the startup scene generally in ASEAN and how you've seen it change over the last few years.
Sure. Well, thanks for that, Brett. So I think fintech started to hit Southeast Asia about 5-6 years ago. So I actually came into the fintech industry in 2016 when a lot of the banks in Thailand, there's a lot of excitement around the term fintech, and a lot of the banks were willing to engage with fintech without perhaps understanding the full scope of what fintech was and where it might go. So I think it's probably worth mentioning that up until a few years ago, Southeast Asia, the economies in Southeast Asia were largely cash-based markets. And, banking was still largely based on physical branches, which meant that, there was a great percentage of people in Southeast Asia that were unbanked because, you could really only access, banks in either capital cities or where the terrain was relatively easy to build out infrastructure. You had a lot of mountainous regions in Southeast Asia. Much of Southeast Asia is peninsula of islands. So, you didn't have bank branches everywhere. Credit card penetration was extremely low. And so, you had unbanked populations, bordering on, 70, 80, 90% in many markets. And so, banking services were limited to a few, still largely cash-based. In the countries where there was a little bit of credit card penetration, it was typically a small number of people owning about 7, 8, 9 cards each. So, but what was really quite interesting
because of all the free toasters, right?
Yes. Although I think I don't even think people toast their bread anymore. That's very much a British thing or a Western thing. But so you didn't have a plethora of sort of modern banking services for the great percentage of the population in these markets, and so the banking industry hadn't really changed all that much since pretty much for the last couple hundreds of years. It was still very teller based, bank branch based. Some of the services were relatively plain vanilla. And so what had happened just probably in the last decade or so was, the rise of e-commerce. E-commerce started to become a big impetus for technology development in Southeast Asia. Also, the one remarkable thing about Southeast Asia is even though banking services penetration was incredibly low, smartphone penetration was through the roof. So, you have economies, I think on average, Southeast Asia has about 130% smartphone penetration. And that's not just a handful of people owning multiple phones, but, you have people up and down, the economic, spectrum, with, anywhere between, $1,000, latest Apple iPhone to, a cheap $100 Chinese made smartphone. And so everyone had some form of internet access, even if they didn't have some form of internet or if they didn't have some sort of banking services. So, with everyone sort of being connected, the rise of e-commerce, that sort of drove the need for digital payments.
And differently from the US, it was more mobile commerce, right? Because in the US it was e-commerce on the web, but it's sort of, as much as anything, it's the mobile commerce layers that have emerged on top of the app framework, right?
Absolutely. I mean, Southeast Asia and many markets in Asia in general, over the past couple of decades, have been characterized by these sort of technological leapfrogs. So, Asia pretty much leaped ahead very early on in sort of the uptake of mobile phones, because there wasn't a lot of landlines. The penetration of POT systems and landlines was tragically low. But all of a sudden, you didn't really need to dig up roads and build out copper wire. You could just set up cell towers across the region. So Asia went through this big leap in mobile telephony. And they started to see that in banking services as well. So rather than try and build out branches everywhere, try to get people onto desktops, try to get people to take up credit cards, you could just leap to mobile payments.
Yeah.
And so we're starting to see that now over the last couple of years. Mobile payment systems have exploded across Southeast Asia. And now we're actually starting to see that trend hit the lending space, because for all the same reasons that people couldn't access, so the opportunity for sort of leapfrogs in the consumer lending space.
Right. Okay. Sorry. Yeah.
Because for all the same reasons people couldn't get normal banking services and setting up savings accounts because they didn't have enough capital. Yeah, it's just being able to onboard, go through KYC. Now you've got technology and mobile technology that enable peer-to-peer lending. It sort of enables alternative credit scoring systems in markets where there weren't national credit bureaus to begin with. And so you're seeing Southeast Asia leapfrog many areas of traditional financial services, and I think that's sort of the great promise of what we're seeing in Asia.
Quite
and
similar
I think
to what we've seen in Africa as well.
Yeah, absolutely. Absolutely. I think where there's lack of infrastructure, digital has a way of taking over.
Well, Paul, thank you for joining us on the 8th anniversary of Breaking Banks. We're very grateful for your perspective. We hope to hear more about what's happening out in the region over time, and hope you'll come back on the show soon.
Thanks, Brett. Happy anniversary.
Thank you very much.
That's it for this week. If you like the show, make sure to give us a 5-star rating on your favorite podcast platform, or share it with a friend, or share it on social media.
We'll see you again next week with more Breaking Banks.